Hi. The secondaries market summary that I'm bringing to you this month is for deals that were announced in the month of August. This is the September edition, but it usually covers the month before. Some very, very interesting transactions. We're beginning to see so much action in secondary that you will broadly see me break up the secondary segment into three parts going forward. One is classic secondary deals, which are usually never standalone. They usually accompany a primary transaction. So that's very common, and that's what we've been highlighting. Last month was probably the first time I brought in the idea of managed secondaries or continuity vehicles, which started getting more prominent and more visible. A lot of them don't necessarily get announced, but we're even seeing announcements in the papers. So that allows us to give you some sense of whatever little information we have. And then the third is inevitably we are seeing even potentially standalone secondaries without the need to be managed or without the need to have a predominant primary part, because the company is on the verge of going public. So that's when the confidence is the highest, and that's also where you see secondary action. So we'll bring you a glimpse of we don't have too many of the last category to report this time, but we'll bring you a glimpse of all of that in this month's edition. So I want to start with the funnest one in where we have a personal relationship. It's a company called Sedemac. IIT Madras has been getting a bunch of love nowadays on having one of the best programs in terms of incubating and building companies out of their accelerator and incubator program. The one other place which has done fairly well on that is IIT-Bombay. And IIT-Bombay, through the SINE incubator, has been up and around for 20 years. One of the earliest, incubator accelerator efforts, both of these, to get both government acclaim funding and the first success stories. So IIT-Bombay had its Idea Forge success story, which went public a few years ago. And I think we're on the verge of seeing the second one. It's a company called Sedemac, right? They make motors, DC motors, and they make them for vehicles or the automotive industry. And if you speak to the Sedemac founder someday, I hope to get him on my podcast as well, nobody believed in him, right? And to Sandeep Singhal's credit at Nexus, he actually bet on them. And it's kind of an anti-portfolio for us. It was too late a deal. It was like a Series A, classic 2011-12 Series A with 50-60 crore valuation. And Blume never played much beyond 15 crores of post-money valuation back then. So for us, this was super expensive, right? And, Rajesh Rai, who was then India Innovation Fund, was doing the next round with Nexus and said, hey, Karthik, you should invest in this company. I think it's a great deep tech company, fun founder. We actually met, and the founder still remembers where we met, at the cafe at the back of the Grand Hyatt in Kalina. And he says, you guys passed on me. I said, no, it wasn't as much of a pass as it was just beyond, it was outside our wheelhouse. And he's very kind. He keeps calling us to all his exit parties. It's peculiar that he throws an exit party every time an institution exits the cap table. So I went for the one which he did for Nexus, and then just last 2 weeks back, I went for the one he threw for Iron Pillar, which is our first story of today. So this company just then grew with very little capital and then got profitable and then just kept compounding. And today it's a beast. I can't speak of the specific numbers. I think the company's planning to go public. So hopefully everybody will know about Sedemac fairly soon enough. But I can tell you that it's gone from the lower few hundred crores to like the higher few hundred crores in revenue. It is EBITDA positive. It is gone from literally an entry point. The round I missed, 50 crores or 60 crores. Today that company, a year and a half ago when Nexus did the exit, was at some 2,500 crores. Today it's upwards of 4,000 crores. Fascinating, right? So it just grows very fast once you start seeing profitability. And Iron Pillar had bought into the company at themselves as a combination of, I think, primary and secondary at one point. And that fund is, I think, coming to a natural close. Iron Pillars had a great run. They had a Bluestone IPO. They had a Viome IPO. And the Sedemac secondary all in a week. We know that team very well, so I'm happy to give them a shout out. They had a fantastic week where all three big exits happened. And my colleague Vikram will cover the IPOs because he does that segment. So Bluestone and Viom will come on his segment. I'm going to cover Sedemac because they picked up, they managed to get an exit on a stock that they've not bought too long ago, and basically got a very handsome return. I don't know all the specifics of the deal because it's a private deal, but Sedemac essentially, as I said, is someone who does indigenous IP-led powertrain controls and engine management systems. So hardcore engineering, and it shows the power of deep tech in India. It's also the day, by the way, I'm recording this segment on a day where Blume joined the Deep Tech Alliance in the country, and I think that's a very heartening moment for us because we believed in deep tech from day one, and we have some phenomenal stories in companies like Grey Orange, Carbon Clean, Ethereal Machines, Nico Robotics. And one of our investors, Catamaran, is also an investor in Sedemac. So people believed in the company, they stood by the company, and it's fantastic to see a company turn profitable and potentially list in India. And more of these stories will drive the deep tech sort of narrative in India. So once again, kudos to Shashi, the founder. I did tell him that as quiet as he wants things to be, I will give him a shout out in my secondary segment. And so, hey Shashi, congrats and good luck for the IPO. The next coverage of yours should be in Vikram's segment at some time in the future. Full disclosure, I plan to buy a small personal stake because I missed on the Blume stake into Shashi's company pre-IPO. He's been generous enough to find me a few shares. And so I want to ride this journey that I missed 12 years ago. So that's how long sometimes it takes to, regretfully buy late into a company. But I think he's building a great company. Then Innovaccer is one of the hot SaaS startups built in India for the world. The founders moved to the US in almost 10 years ago and got a lot of inroads into healthcare in the US. And rumor has it that they're a $250-300 million ARR company. I first met them and ran into them in the Valley. By then they were too late. We used to be a very small fund 10 years ago, and they were already 2.5 million ARR, and they were raising a $10-15 million round, which is just way out of our wheelhouse. So we didn't end up playing this company, but we've been cheering them, and we know some of the founding team who are now setting up micro VC funds. So huge respect for Innovaccer and its scale that they've built in the US market. And Lightspeed was one of the early investors. And so the second story today is Lightspeed finding an exit. They basically, I think it got announced recently, but I think the deal was done earlier this year, somewhere close to a $3 billion valuation. And it was a large round, 275 million or so. And about 35% of that was secondary. So this is, again, not very unusual at all. When companies become unicorns, there's usually a multi-$100 million round. We've seen that in Purple in our company earlier this year. We saw it in Lenskart over the last 2 years, which is likely to go public. And basically at that juncture, some of the early investors take a big chunk. They can get 50 or 100 million out. And that's a very big chunk that you can get. You can't get such large chunks when the company is less than $1 billion. But when it crosses $1 billion, even 2% is 20 million, like we saw in our company, Spinny. So 5% becomes 50 million. At 2 billion, 2% becomes 40 million. So there is enough demand. When there's enough demand in a $200-300 million round, you'll see $50 to $100 million go in secondary. That's what happened here. The press reports, I don't know how to do the Lightspeed math. I don't know the entry or exit point, but it says that they made over 30% IRR. And the incoming investors were folks like Kaiser, Permanente, B Capital. They seem to have entered and done the deal part primary, part secondary. In the Iron Pillar Sedemac deals, unfortunately, we don't know. We know the buyers. I think they were very cleverly, they're public market buyers from what little I know, very long-term holders. both names not familiar to me. I should have had them on my cheat sheet. But Sedemac cleverly put them on a LinkedIn post and said, we welcome these two new investors on the cap table. So that's a very subtle way of saying they're the ones who bought the Iron Pillar stake. So you can go check that out. There's a company called Vistaar Financial Services, and classic case of MSME focused NBFC, small ticket loans, working capital finance to micro businesses, shop owners, and basically there were two incoming investors: ABC Impact, which I think from what I know is Temasek backed and anchored, a Singapore-based impact investor, and Motilal Oswal, who's now the hottest homegrown sort of private equity institutional offshoot brand today. They led like this fancy round in Zepto, as people might know. Of course, I'm not discounting from Kedara, Multiples, Chris, etc. But Motilal Oswal came from a securities firm and just recently announced like an $800 million fund. So they're flush with capital. They're getting a lot of love from the markets, and they're writing really bold, big checks. So they came in, and here's how the private equity market works, interestingly, in secondaries. They bought out Warburg and other investors. So here's a large domestic private equity firm, much like in the public markets where you hear news of, FIIs getting out of the country and DFIs, domestic financial institutions buying into DIIs, domestic institutional investors buying into these companies. You're seeing that in private equity now. So Motilal Oswal and ABC bought out Warburg and other investors. It was a 1,360 crore deal, fairly sizable, 870 crores primary and 490 crores secondary. We don't know the valuation, but give or take, this could have been a 10-15% dilution. So somewhere maybe above $500 million. But, I think classic case of growth capital coming in, but also some existing investors taking money off the table. And this is exactly what you want to see as a function of a robust private market, and very common in the PE side of things to see a steady state business get that kind of love before the company starts planning to go public, etc. Then I find an interesting company called Aragen Life Sciences. So Aragen Life Sciences is basically India headquartered contract research, development and manufacturing organization. So the CROs, and this is like an extension of that, is a CRDMO, abbreviated. It serves pharma, biotech, global clients. It's a high growth, export oriented business. So this was interestingly bought into by Avendus Future Leaders Fund 3. I think they've been running these fund ideas, which are like a pre-IPO pre-IPO sort of design fund, and SBI Life Insurance Company. So both of these participated in the secondary purchase. If I'm not mistaken, this might have something to do with the GVKs. I should have done a double click on this, because the seller is Reddy Investment Trust. So it was a promoter holding entity. It used to be called GVK Bio, I think, and now it's got this new name. And basically, the valuation and round size, about 300 crores reported as a secondary purchase. Just a little over 2.5% of secondaries for a company that's valued at 12,000 crores. So you'll probably wonder what is going on here. Like, why is somebody buying such a small amount in such a large company? But this is exactly the point. The company's getting ready for public. And basically, there are pre-IPO buyers who essentially want to pick up a block that they might not get allocated in the public issue, right? And they're hoping to see a 20-30% premium from this point by the time the company gets ready for going public. So this is a classic pre-IPO, path to IPO kind of a secondary investment, which I thought was fairly interesting.